Investors, I'm sorry to say it, but Wu-Tang got it wrong. Cash doesn't rule everything around me. Credit rules everything around me. I explained in part 1 of this series that credit is what drives the economy. Credit is what gives us booms, busts, and financial crises. And credit is what creates debt cycles. So if you want to understand why the economy really works, and why we actually get recessions and market crashes, then stay tuned because today I'm going to teach you all about debt cycles.
Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy?
What's going on, investors? AK from Fallible here. Now, in part 1 of this series, we talked about the economy's average growth rate of 2% a year. Whenever we push above that level, it's because we're taking on debt, we're leveraging up. And when we fall below it, it's because we're paying off that debt, or deleveraging. This leveraging and deleveraging process happens through short and long-term debt cycles. The short-term debt cycle is basically the business cycle. It occurs every 5 to 7 years. And who drives this cycle? Yep, it's none other than the Federal Reserve. If you missed the video series on how the central banks manipulate interest rates in the markets, then I'll link to that video above. Say the Fed wants to stimulate the economy by lowering interest rates. Well, lower interest rates means it's cheaper to borrow money by taking on debt. So people start borrowing more and spending more. And one person's spending is another person's income. So everyone's income starts to rise and they start spending even more. Home prices, stock prices, and the prices of pretty much everything start to increase because of all the spending. And this makes people feel even richer because the value of all their stuff keeps going up. So they start spending even more. This eventually creates a reflexive loop that boosts the economy. If you're unfamiliar with reflexivity, we made a video that describes what it is. I'll link to it above. This reflexive process continues until there's so much spending that the economy can't even produce goods fast enough to meet demand. When this happens, the prices of goods shoot up way too fast and you get too much inflation. But we know the Fed has to control inflation. So when they see this happen, they raise interest rates to slow down the economy and keep prices stable. This throws the feedback loop into reverse. It becomes more expensive to borrow, so people borrow less and then spend less. This causes incomes to fall, which again reduces spending. Demand falls off and the economy slows down as we go from boom to bust. That is, of course, until the Fed decides to stimulate again by lowering interest rates again. But this time when they cut rates, because there's already debt left over from the last boom cycle, they need to lower rates even lower than they did before. They need to make sure people can pay off their old debt while still taking on new, cheaper debt. This short-term business cycle happens over and over again as interest rates move lower and lower. But at some point, you hit 0 or negative interest rates and you can't go any lower. And that's when people can't take on any more debt, which is where the long-term debt cycle kicks in. The long-term debt cycle only happens about once a generation, or every 20 to 50 years. You can see in this chart how interest rates made a long-term peak in 1920 and then turned over leading into the roaring 20s. They bottomed out in the 30s and 40s and then headed higher for the next 40 years. Interest rates peaked in 1981 before trending lower once again to today. Total debt grew over the long term too, which you can see in the two debt mountain peaks on this chart. There was one in 1929 where total debt peaked at 260% to GDP, and then the peak today where debt is closer to 380% of GDP. And you know what happened in 1929 when debt peaked. We got the Great Depression where all that debt had to be cleared from the system. People can't keep adding debt forever. Eventually interest rates hit a bottom and the system gets maxed out. And that's when you get once in a lifetime horrible economic conditions. Now fortunately our team at Fallible will guide you through these debt cycles so you can hold on to your money. So make sure to subscribe below and hit that bell for notifications so you know when our new videos are released. But in the meantime, stay fallible, investors. Bye.
Wouldn't it be crazy? Would you still amaze me? Wouldn't it be crazy? Would you still amaze me?